Hello, fellow traders. Tis I, TheRumpledOne, coming to you on Tuesday, March the 21st, the year's 2023. Let's talk trading, hedging with Walmal. These videos are for educational purposes only. Your results may differ from mine and differ from Walmal's. Walmal, we had a trader wanted us to talk about hedging. So you said that you do it slightly different from me, so I'll let you go first.
Okay. Essentially, what I do is, my whole value whack, I guess, if you want to call it that, fancy word for all that I do, is that I'm just trying to manage money. That's all I'm trying to do. Is that, I use different strategy, well, actually one solid strategy and different tactics within that to do nothing more than to manage money. And so, you know, I don't go into things and look and say, hey, well, I'm biased long, or hey, I'm biased short, or I'm biased this or that. I don't look at the market that way. I look at the market from the perspective of, I'm going to take a trade and, hopefully it goes in my direction. And at the end of the day, I will go and make money. And so what I'll do is, I'll go into a trade. And let's say I get through through my method, it tells me to go long at a particular level, and it goes against me. What I'll do is I will go and sometimes I'll just go and add in at that point in time, or actually average in, see if it works for me, and try to go and mitigate how much it's going against me, how much it's going against me. If it continues to go against me, at that point in time, I have to go and make a decision. And the decision that I make is, do I just jump out of the trade, or and take the loss? Excuse me. Or do I go and try to hedge this because I really think that, based on what I see on the charts, it's going to come back in my direction. So that's where I go and hedge in, and I usually hedge in the sense that, let's say I went to two trades in the long direction. And so that would mean that a true hedge would mean that I take two shorts, assuming the same lot size. Okay. But what I'll do is I'll actually go and put in three shorts at that point in time. And the reason why is to try to take advantage of the move in my particular direction. And then, so it kind of goes against, my overall idea of, keep things simple, because now all of a sudden I'm in five trades, one, what I call a deal, but in five trades. But if you really boil it down, I'm really just, in the talking hedge, I'm biased in the short direction. So I'm only biased in that direction. Then what I do is I just wait for the logical point of where this is stopping. And, if it continues to go short, I just leave it that way. And I may average in fact, if it's working in my direction favorably. And probably the best place to follow would be just to drop the shorts at that point, but I usually don't. I usually hold on to the shorts, and what I'll do is I'll just keep, because now I'm in one or two above what my longs, so I'm okay. I'm making money. And so that's the bottom line. I'm looking to make money. And when I get to the particular place where I've made the money that I want to make on the particular the particular trade, at that point, more times than not, I just abandon the whole thing. What I mean by abandon the whole thing, I close my shorts, I close my longs, I get out of everything, and I just take the money and put it into my pocket. That's kind of how I do my hedging. It's a little bit different than what most people do, but then again, I'm just looking at the dollars at the bottom of the chart. That's all I care about. I'm just trying to make a particular amount of money on a particular trade.
Right. Okay. What I do to hedge is, or when I hedge is when I want to stop the bleeding. So let's say, for example, I was long at 22.50 right here, and now I'm at 22.45. So what I could do is I could put a short on. And so now I'm hedged, I'm down 5 pips, but I'm locked in. So the thing that um, I would do from this point is I would wait for something to happen that either tells me to go long or to go short. Because see, right now I'm in the launch pad, so I'm thinking, long. I'm thinking long. I'm thinking long. But obviously, price has gone almost all the way through it. So I would just wait for a signal, then get in. But I wouldn't take off the very first short because what's happened to me more often than not, I'll say, oh, it's going back up. I'll take the short off and then it tanks on me. So now rather than having a 5 pip hedge, now I might be back short at 22.40. So now I've got a 10 pip hedge and I've just made things worse. So that's the one thing I do. So in this case, if I had been short, say at 45 and I was long at 50, I just wait for what I thought was a good signal in either direction, make up the 5 pips. Then I can start playing with the the two trades that are in the hedge. I'm thinking, okay, if I take the short off here and it's going long, then I can maybe make up that 5 pips once again, and now I'm ahead of the game. Because what can happen and what you don't want to happen is to get in a position where you're just making back your loss. You're not making any money, and that can happen real
Yeah,
quick.
and that's kind of what happens with me with the way I'm doing my hedging is because what I'm doing is I'm just trying to go make up the money I'm bleeding out because I've gone in the wrong direction. But because I've got that extra trade on there, I'm able to go and continue to make money there. And then what I'll do is, I'm in 5 trades. Some people who do the tactic that I'm using, they'll go and just continually add and add and add. Well, the thing is, I don't have $1 million account out there, so I just can't do that because you run out of equity at some point. So what I do is I just go and add and subtract, you know. And what I mean by that is, let's say my bias all of a sudden now goes from my example from before. Now, my bias was now short because that's where the direction is that it's running. Okay, and then it turns to go long. What I'll do is I'll drop, you know, one or two of my shorts, okay, and just let it run in the other direction. And then if I got to go back the other way, I'll go and do it. I'll just flip it around the other way. And by doing that, hopefully, if you're doing it right, you're picking up. You're not picking up a lot. And with my method, because I'm only looking to make 2-3 pips, maybe 5 pips on a trade, you're only picking up a pip or two. But those pip or twos, when you go back and forth like that, until you go and finally get flat again, the nice thing about it is that you could easily pick up, 10, 15 pips just by going back and forth like that. And just a couple of warnings. One, this is not something that's for the faint of heart, because when you see, the fact that your equity has been chewed up. Now, the amount that you're winning or losing doesn't change that much because you're hedged. But you are paying commission on all those things. You are having to go and factor in spread on all those things. So it is costing you money to do this. But the thing is, you can pick up some. It's a nice way to go, and for me anyway, to go and manage my money and pick up some money and do that. But at the same time, it's not for the faint of heart because you can, if you mess up, okay, and you take off the wrong trades, you can really put yourself into a mess very, very quickly.
Yeah.
So I wouldn't suggest this for the average trader. You should be. My opinion is you should be making money before you go into the hedging game.
Right. And the other thing about hedging is it's really more managing the emotions, even more so than managing the money. Because if you're like me, you hate to lose. And so what you do is you put that hedge on, and then when you get out, you close out everything green. But the reality check is, it's when you look at your individual trades, you're going to have a loss. So, for example, on this one trade here, had I gone long at the 50 and then short at the 45, here it came back. And if I would have put on another trade somewhere below 50, that we had to open at 46.5. So let's just say I put another long one at 48. When it hit that 55, I could have punched out with a win. But that hedge trade would have been a loss, and then the two long trades would have been wins. But when I'm punching out, psychologically, I'm winning. But the reality is, I could have taken a loss rather than put the hedge on. Then I could have gotten back in on the signal, and it may be actually made even more money. Because if I would have taken the 5 pip loss, and then as soon as this thing went green, then here I could have picked up 7 pips, say if I went long at 48, and so I'd be up 2 with a lot less, stress.
Right. And that gets really down to one of the points of why did hedging exist in the first place? Well, the main reason why back in the old days why people would hedge more than any other reason is that what it did was it put a hold on your account. If you sat there and you like something happened and you have no idea what's going on, but something just doesn't smell, as the expression goes, something stinks in Denmark, right?
Right.
And you just can't figure out what to do. You hedge it, okay? And that's it. Even a beginning trader can go and do that.
Yeah.
Just hedging. That way you get some time to think about and look at the charts and say, hey, this is where I'm at. Yeah, it costs you money to do it, but it gets you out of a situation where you make a emotional decision. Gives you what it basically does is give you time to go and get out. Now, you may also go and lose out on the opportunity, but you're going to lose out on the opportunity anyway because you didn't know what to do. That's the downside to it.
Yeah. Speaking of time, how much time do we have left?
I can tell you that in a second here. We have about 2 minutes left.
Oh, okay. One thing also about hedging, be careful if you come to the rollover period, because that maybe your 1 pip spread becomes a 20 pip spread and it works against you twice, and you can see your account go bye-bye real quick.
Exactly. So if you're going to do hedging, point is, I don't like to hedge across news or across rollovers or anything like that. And the reason why is just exactly what TheRumpledOne said, because no doing on your own, just the reality of what can happen at those critical points in the day.
Yeah. So, fellow traders, we're just answering a question about hedging. We're not advocating it because it's not what you trade, it's how you trade it. So go out there and drain the banks. This is TheRumpledOne, over and out.